Welcome back to another episode of What's Happening with Our Economy. Before getting started, don't forget to hit the like and subscribe button if you enjoy videos like this and many others on my page. Today we'll be discussing the surging dollar in recent months, how it impacts global inflation, the American economy, and what you can do to make a profit from it. The United States is facing the possibility of a currency crisis because of a surging dollar and rising interest rates. While domestically, the worth of the dollar has gone down due to inflation and negative real interest rates, abroad, its value has risen in recent months. The dollar is up 11% this year and last month hit a 20-year high according to the ICE US Dollar Index, which measures the dollar against a basket of other key currencies. Why is the dollar so strong? The dollar is strong because the US economy is healthier than other economies. Europe in particular is struggling with high inflation and slow growth due to energy supply disruptions resulting from the war in Ukraine and may have already entered a recession. As the Federal Reserve began raising interest rates in March, increases in government and corporate bonds have lured investors in emerging markets, driving up the value of US currency as they began dumping their own currencies due to inflation. This is primarily due to the fact that their own currencies have begun to devalue against the dollar. Evidence of this is seen in the US dollar being at its highest in decades against the British pound sterling, the Japanese yen, and the Chinese yuan, and other government currencies. The buying of US bonds by foreign investors and overvaluation of the dollar internationally can prove detrimental to the American people. And here's why. High inflation around the world and the Russian-Ukraine war continues to drive up prices for energy and commodities like oil. With emerging markets' currencies devaluing, a surge in the dollar has caused difficulties in economies around the world, above all in developing nations that import commodities by paying in US dollars. These same developing nations are no longer getting the same bang for their buck, meaning they are now paying more for less. To illustrate this, consider the price of a barrel of oil in dollars versus the Ghana currency. At the beginning of October last year, the price of oil stood at $78.52 per barrel, rising to nearly $130 in March before falling back to $88.91. In 1 year, that is a 12% increase in terms of dollars. Over the same period, the Ghana cedi has weakened over 40% against the dollar, meaning that same barrel of oil that cost roughly 475 cedi a year ago now costs over 900 cedi, almost twice as much. A surging dollar is bad for other countries because it adds to the global inflationary pressures at a time where there is record high inflation by squeezing companies, consumers, and governments that borrowed in dollars. In emerging markets, more local currency is needed to convert into dollars when making loan payments. Consequently, this forces central banks and other currencies to raise interest rates to try to prop up their own currencies and keep money from fleeing their borders. But those high interest rates also weaken economic growth and drive up unemployment, similar to what is happening in the US as described in my earlier videos. Many foreign investors see the dollar as the safest assets to hold when stock, bonds, and other markets turn volatile as they have this year. That's partly because the dollar has a unique status as the world's reserve currency. Central banks and financial institutions around the world hold lots of dollars to use for international transactions. They do this because using a single currency rather than having to convert between multiple currencies enables international investing and lending. As a result, a surge in the dollar has begun to threaten the US dollar as the most prevalent global reserve currency status. The US dollar is not the only global reserve currency in the world, though it is the most popular one. As of March 2022, the International Monetary Fund, or IMF, approved 4 other reserve currency, being the euro, British pound sterling, Japanese yen, and yuan. It is important that the dollar has competitors as the international reserve currency because it creates a theoretical alternative for the rest of the world in case American policymakers lead the dollar down a damaging path. However, if the US dollar were to lose its position as the world prevalent reserve currency, the demand for goods in the US would subsequently fall, degrading the standard of living for all Americans. If for some reason foreign investors and or governments decide to switch away from the US dollar, the sell-off of the US dollar can significantly hurt anyone with assets in US currency. Leading us to our next topic of the day, government spending. Government spending has seen a fiscal deficit in recent years. Rising interest rates means higher debt payments, which in turn means higher overall debt. In 2022, the federal government collected $4.9 trillion in total revenue and spent $6.3 trillion. In 2022, the federal government spent $1.4 trillion more than it collected, resulting in a fiscal deficit. Currently, government debt is $31 trillion. Every 1% increase of interest rates will result in $310 billion net increase in overall debt payments. This kind of monetary policy is unsustainable if rates remain high for an extended period of time. If the Federal Reserve creates money and the U.S. government assumes and monetizes debt faster than the economy grows and defaults on their loan payments or not being able to pay back their debts, the value of future currency would fall. In other words, of all the preconditions necessary to force a collapse, the most reasonable scenario for a sudden collapse in the dollar would be a dual threat of record high inflation and debt. A scenario in which rapid rising consumer prices forces the Fed to sharply raise interest rates. However, it's important to point out some experts believe the collapse of the dollar remains highly unlikely, as virtually every alternative currency is backed by similar economic policy. Even if the dollar were to falter, it still may very well be stronger globally due to its relative strength to the alternatives. Analysts like to point out that foreign exporters such as China and Japan do not want a collapse in the dollar because the United States is too important of a customer. Even if the United States had to renegotiate or default on some debt obligation, there is little evidence that the world will let the dollar collapse and risk possible contagion. Recently, the dollar has weakened some amid to softening inflation data, suggesting that peak CPI inflation was back in June at 9.1%. Though inflation has weakened to 7.7% year over year, it still remains abnormally high and far above the Fed's target of 2%. To put it into perspective, if inflation were to stay at 7.7%, the prices of goods and services would double every 14 years. It's important to note that the full effect of government interest rate increases don't affect the economy until 6 to 12 months after the increase due to economic lagging indicators like rent increases, which go up on a semi-annual to annual basis. Which is why most experts expect inflation to become increasingly stickier and harder to bring down once in the 4 to 5% range. Once again, this raises the questions of how high do we raise interest rates and how long do we keep them high while not significantly damaging the economy, subsequent financial markets, and increasing fiscal debt. In a study conducted by the federal government, it was found after inflation began to spike, it took 2 to 3 years before it subdued. Although concerns of a surging dollar and the US dollar crisis have quelled somewhat amid softening inflation data, and the dollar slid on hopes that slowing inflation will encourage the Federal Reserve to back off its campaign of aggressive interest rate increases, with only increasing rates by 0.5% or 50 basis points, which would be down from previous rate hikes. As always, I implore you to stay safe, and the best course of action in these uncertain economic times is to continue to stay employed. 1. Build an emergency savings fund with 20 to 30% of your income. 2. And 3. Regularly invest into the market, aiming for a long-term growth and diversifying your portfolio with stockpiled cash, bonds, U.S. and international single stocks, and/or index funds with high dividend payouts. Thank you again for watching this video, and if you enjoy content like this, like and subscribe for more, and stay tuned. As always, have a nice day.